Welcome to Nedgroup Investments Quarter 3 Economic Overview. If we refer to slide number 1, domestic asset class returns, one will see that the all-share index was down 2.2% over the quarter, largely led by the top 40 large-cap stocks. These are large global stocks that were hurt by the sell-off in emerging market equities, largely fueled by Donald Trump's trade wars. In addition, we have deteriorating economic factors within South Africa that also badly affected the South African listed property market, which was down minus 1% over the quarter and is down nearly 16% for the year. A lot of new office supply has come onto the market with little take-up, and hence vacancies rates have increased within the listed property companies. We also saw large outflows out of the fixed income space, with foreigners selling over 66 billion rand worth of bonds over the quarter. This put pressure on the all bond index that reversed some of their losses over Q2 and ended up going up by approximately 80 basis points over the quarter. Interest rates remained unchanged over the quarter, resulting in a consistent 1.6% return to one's cash holdings. If we look at the global equity markets, we see that again we had a very strong quarter in terms of global equities, again led by the US, with its market really booming. Global equities were up 4.4% over the quarter and are up 10.4% for the past 12 months in US dollar terms. Global property also took strain over the quarter, down negative 0.2% for the period. And this was on the back of people expecting interest rates to rise in the US, which has a negative knock-on effect onto global listed property. If we look at the exchange rates, we can see that the rand weakened against all the three major currencies over the quarter by between 2 and 3%. The US dollar was strong over this period based on strong economic fundamentals coming out of the US and people expecting interest rates to rise. The UK is still under pressure in terms of its Brexit negotiations, and this had a negative impact on the pound relative to the dollar. And in addition to that, the euro was also affected and the currency slightly spooked by the new Italian government that is populist-led and has anti-European Union sentiment. If we go over the slide to domestic performance drivers, we see that there have been many actions over the last quarter that have affected the market. South African GDP contracted by a further 0.7% over the quarter, indicating that South Africa has actually entered a technical recession for the first time since the global financial crisis. This is classified as 2 negative consecutive quarters of contractual economic growth. This contraction has sparked extra concerns and renewed people's fear for further credit rating downgrades by Moody's and S&P. We also have just had the medium-term budget speech, and Tito Mboweni, the finance minister, also downgraded South Africa's economic growth figures from 1.5% down to 0.7%. The Reserve Bank has kept interest rates unchanged at 6.5%, and this was largely on the back of inflation figures that actually slowed during the month of August, down from 5.1% to 4.9%. In addition, it has been announced that the visa regulations for people entering into South Africa with minors and their need for unabridged birth certificates has been relaxed in a bid to boost tourism to this country. Finally, the debate on land expropriation continues, and the government has announced that a draft bill will be released for public comment in Q4 of this year. On the global side, volatility has remained relatively low, while risk assets performed positively over the period. This positive growth has largely been driven by the US economy that makes up approximately 50% of the world stock market by market cap. However, emerging markets have been taking strain on the back of a strong US dollar as well as risk-off appetites across emerging markets, and this has been highlighted particularly by the Argentinian, Italian and Turkish economies, where the currency and stock markets have taken major strain. Of course, what are the factors that are making the markets sensitive and jittery are Donald Trump and his tariff war with China, which time will tell whether this tariff war escalates or perhaps can get negotiated out for everybody's benefit. So overall, again, a very interesting quarter, with the South African stock market taking pressure and strain due to emerging markets having a risk-off appetite, while global markets, largely led by the developed economies and particularly that of the US, had another strong quarter, and we shall wait to see how this continues going forward.